The first meeting is really a get-to-know-you meeting. We're going to sit down. Typically, the meeting will last about an hour. We're having a conversation. My job is to ask them some questions about where they are, what some of their goals are, what some of the key objectives they have in meeting with me, where they are to this point, and really what brought them in to see me. And now I'm at the point in my career where I have a lot of people that are dependent upon me to provide them with all the guidance and all the advice that we do on a day-to-day basis.
You spend your working years trying to build up your assets, trying to build up pension credits at your job, trying to grow your nest egg so that you can one day retire when you can't work or don't want to work anymore. And that's a period followed by phase two, which is retirement. And your priorities in these two phases are very different, but many times we see people don't make that shift and they still act like they're in phase one when they really should be acting like they're in phase two.
We're going to talk to you about what we commonly refer to as the second half of the game. And what I mean by that is you're working your entire life towards retirement, and I'm assuming that most of you are, at that age where you're starting to consider some of your options as you move into retirement. And as you do that, you're moving from what we call the accumulation phase of your life, where you're accumulating your assets. Maybe you're participating in your company's 401k, maybe you're contributing to an IRA account or a Roth IRA account or some type of retirement vehicle. And now, as you retire, you're transitioning into the distribution phase, or the part where you're going to need income in retirement. So we're going to talk about some different ways to do that with an emphasis on Social Security.
Hello, I'd like to welcome you to Financially Speaking with Jeff Bush. My name is Steve Jablonski, and I'll be the host for today's show. With the financial markets being at an all-time high, our clients are wondering what are some other options that are non-equities that would be a little bit safer. So today's topic of the show is fixed income, more specifically bonds. With that said, good morning, Jeff.
Well, hello, Steve, and welcome to the show. We're here in the dog days of summer, as they say, but yeah, the markets are at an all-time high, and it's making people nervous, and understandably so. If we look at what's happened over the course of the last 8 years, the markets have climbed quite a bit out of that doldrum and disaster that we had back in 2008. So this will be a good, timely discussion.
Oh yeah, and how would you see bonds fitting into clients' overall portfolios?
Well, Steve, bonds are used to stabilize a portfolio and really minimize the overall risk in a portfolio. So if you have a portfolio of stocks, the stocks are very risky. So we have a slide, I think if we can get the slide up, which shows the performance of the stock market over the past. I guess we go back about what, 20 years on this or so, and you can see that we've got a lot of volatility. The market's climbed up 231% since we hit a bottom back in March of 2009. So that's pretty significant. So equities are a good place to be in a portfolio, but you want to have stability with bond holdings. So what bonds do, there's not near as much volatility. So the bonds tend to stabilize your overall portfolio.
And are we talking more about specific a bond itself, like a corporate bond, or just one? Or are we talking about bond funds? What's the differences?
Well, it depends. I mean, in our practice, we like bond funds. The reason why we like bond funds is because it's easier to manage risk. If you have smaller size portfolios, it's hard to get proper diversification buying individual bonds because you have to buy them in such large quantities. But if you're buying into a bond fund, you're getting instant diversification because you're actually buying shares into a fund that's holding hundreds and hundreds, possibly thousands of different bonds inside the portfolio. So in the mutual fund, you're part of a club of thousands of different investors that are holding these bonds, and you can really get good diversification inside that bond fund. You can get different types of bonds, as you mentioned. You can get corporate bonds, you can get government bonds, you can get municipal bonds, and then you can get bonds of different quality inside of that mutual fund.
And I don't know if everybody really knows what a bond is versus an equity or a stock. So what would be some of the differences?
Well, a bond is debt. It's an obligation. It's an obligation to pay. So if you look at it just from a corporate structure, how it compares to a stock is if you're a bondholder, you're standing at the front of the line to get paid. Okay. So let's say you have a corporation that wants to issue a bond, and they have an obligation to pay you an interest rate, or what we call a coupon rate. So let's say it's 5%. Okay, so you buy a $1,000 bond, and it's 5%, so that's $50. So the corporation owes you $50 a year for holding this bond. The corporation is actually issuing this bond because they need to raise capital. Okay, maybe they're expanding their business. That's generally what it's doing. Maybe they're either in an expansion mode, they need to build more infrastructure, more facilities, whatever it may be, and they decide that they want to float a bond or issue a bond, I should say. So what they do is they go out into the marketplace and they sell these bonds. So you're buying these bonds at a coupon rate. So that coupon rate, or the interest rate, is based on that company's ability to pay. So the company has like a bond rating. So there's different rating agencies, independent rating agencies, that says, okay, you have a high quality bond here. You have an A, maybe you have an A rating, let's say. So your interest rate is going to be less than the other company that's issuing the bond that doesn't have such a high rating. They may have a B rating, mm-hmm. So therefore they're going to have to pay a higher rate of interest for the simple reason that the default rate is greater with the B company versus the A company. Okay, so you're standing in line waiting to get paid the interest, the 5% in this example, and how that compares to a stock. So let's say I'm a bondholder in that company, and let's say, Steve, you're a stockholder. I'm in front of you in line to get paid. So let's say there's a dividend that you get paid as a stockholder. They have to pay their bondholders their debt obligations before they pay their stock. So I'm going to get paid before you do. And then if the company gets in trouble and they end up liquidating for whatever reason, I'm going to get paid before you do. The bondholder always gets paid before the stockholder. So therefore, I'm taking less risk, yep. But the reward is greater for you, because as the value of that stock goes up in share price, you benefit. Right. If they want to pay an extra dividend, like a capital gain type dividend, you benefit. Okay. The only thing I'm going to get is my 5%. So it's more stable, mm-hmm. for a bondholder, but you get a greater reward on the back end as a stockholder.
And we talk about risk. If we go back to the market, the decline 2007, 8, mostly 2008, How did these do in a down market?
Well, 2008 is kind of an anomaly, and I'm not sure that's the best example, but we'll use that example nevertheless. And the reason I say that is because not only did the stock market collapse in 2008, but we also had a crisis in the bond market, simply because the crash was related to the financial markets. It was there was the mortgage crisis, and we had the whole thing with Lehman Brothers, and which was a big bond holder, and there was a lot of bond strategies that didn't do particularly well in 2008. Now some did, and with some of the strategies that we used did okay in 2008, but there was really a crisis in the bond market. Now, having said that, when we say crisis, we're talking about maybe bond funds losing 3 or 4 or 5% if they're quality bond funds, okay, versus the stock market losing 38%. The stock market downturn in 2008 was really significant. So it still is valuable to hold bonds in a portfolio because of the diversification that it gives you, and which then in turn minimizes the overall risk in a portfolio.
And we've talked about the past. What would be the outlook for bonds moving forward in the environment we're in?
Well, that's a good question, and it's a question that we often get asked because of the low interest rate environment that we're in. And there's this phenomenon with bond prices that have what we call an inverse relationship to interest rates and the movement of interest rates. So and I call that the seesaw effect. So as interest rates go up, bond prices go down. Okay, as interest rates go down, bond prices go up. So it's a seesaw effect. So logically, you think, well, we're in a pretty low interest rate environment. We've been in a low interest rate environment for quite some time. And as interest rates begin to rise, and we're starting to see that, bond prices can't help but go down. Okay, so now I'm going to make my argument for the bond fund. Because what happens in a bond fund is you're constantly having turnover inside of a bond fund. You always have bonds that are maturing, and as interest rates start to go up, you're renewing bonds at higher yields. Okay, so you may see some fluctuation in performance in a bond fund in a rising interest rate market. But it's going to be relatively short-lived, because eventually what's going to happen is you're going to have the higher yielding bonds inside that bond fund. Okay, now there's another reason why we like the bond funds, and that's because of some hedging mechanisms that these bond fund managers use to try to mitigate the effect of interest rates. Mm-hmm. So they used options, yep, to and derivatives, and it's really not within the scope of our show here today to get into options and derivatives. But what they do is they have a negative effect, or I should say an offsetting effect of the interest rates. So really we get the interest rates and the prices moving in the same direction. So there's a percentage of the portfolio that's in these derivatives, which really reduces the overall interest rate risk inside that portfolio. That's why we really like the bond funds.
And a lot of times, Jeff, we hear of asset allocation. I know Informed Family talks a lot about asset designation. Can you tell me a little bit about that?
Yeah, so what that does, and I think we might have a slide on that if we can get our little umbrella slide up there. There we go. I don't know why I called that the umbrella slide. I guess it's because we have the umbrella on top, the protection umbrella. But basically, what asset designation does is it puts your investments, your assets, along a timeline. So you see on this this slide if you look at this pie chart, you have short-term growth, or short-term income, I should say. You have mid-term income, you have long-term income, and then you have growth. So you have, so in its simplest form, and we actually have a name for this. We call this our asset cycle portfolio. So what we do with asset cycle portfolio is we give every asset a job description. So every asset in your portfolio has a very specific job. So let's start in the lower left-hand quadrant there. You have short-term income. Okay, that means that that asset that's designated for short-term income is going to give you income now. Maybe for the first 5 years of this plan. Okay, so very little risk in there. So that may or may not be a bond account. You know, maybe we may have that may be cash. It may be an immediate annuity. You know, there's a couple different ways we can solve the short-term income need. Mm-hmm. But where the bond portfolio really comes in is in the next grid, which is in your upper left-hand corner, the midterm income. That's really where you cover the bond risk there. And even with a long-term income to a degree, you can put bonds in either of those two asset designations. And then the bottom right-hand corner, we call that one growth. That's where your stock is. Okay, so I guess in its simplest form, you're buying bonds and stocks to meet different periods of your investing life.
Mm-hmm. And with the bottom, we have live-on assets and then leave-on. Does that have to do with the legacy transfer?
Yeah, so live on and leave on. So live on means that it's money that you need to live on in retirement. So that's the circle there. You know, that's the pie chart. You know, that's all that money you're going to live on, presumably, over the course of your retirement life. What happens today is, what retirement today is different than retirement was even a generation ago. So this is not your father's retirement. So what happens is we're reliant less on pensions, mm-hmm. And more on your assets that are basically coming from retirement plans, 401ks, IRAs, or maybe your own savings. So what we have to do is we have to decide when we put these plans together, what are we going to live on? And then how are we going to define our legacy, which is leave on? So that's your leave on money. So as it relates to that asset cycle portfolio bucket or the pie chart up there, that lower right-hand quadrant, the growth, we may never spend that money. We may or we may not. It depends how long we live. It depends on inflation. It depends on health. So those factors creep in there. But eventually, that growth bucket could go down into the legacy transfer bucket, because that's ultimately that defines your legacy. Whether it's your children, whether it's your charity, you know, that money ends up there, okay?
And Jeff, I know at Informed Family Financial, you talk a lot about planning first. So how does that blend in?
Well, it's plan first, invest second. So you really want to, you know, most of the people that come in to see us, they have a lot of stuff. They have a lot of different investments, but it's not really put into a semblance of a plan. It's just investments. So we want to plan first. So we want to plan for all the things that we showed on that chart. We want to plan for short-term income. We want to plan for, if we can get that chart back up, the umbrella. Yeah, there we go. So we want to, when we put our plan together, that's our plan right there. We're planning for short-term income, mid-term income, long-term income, and growth. That's your live-on money.
Okay.
Then we're also planning for your legacy. That's down on the bottom. That's your leave-on money. This is all your plan. So you're doing your plan first. And then a protection umbrella, that's where we have our insurances to protect everything. But if you're planning all these things first before we're doing any type of investing, rather than the other way around, having the investments fit into the overall plan.
And I would imagine eventually you get to product, and how are you set up being that you're independent?
Yeah, well, product is the last thing that we talk about.
Okay.
But as far as our firm, Informed Family Financial Services, we're an independent firm. So we like that because the independence allows us to provide independent advice to our clients. So we're not married to any products. We're not married to any one wirehouse. We're not wired to any one insurance company. We don't have quotas to meet. We're independent. So that means we have relationships with dozens of different companies that we use to fit the bill, whatever those investment needs are. So once we do the plan, then it's our job to go out into the marketplace and find whatever products really fit the bill. And because we're independent and we act in a fiduciary capacity, so fiduciary, that's kind of a name or a word that's been thrown around a lot lately. It's been in the news. It's part of a lot of the new regulations we're under. But basically what it means is that we have to act in the best interest of our clients, which makes a lot of sense, right? I mean, here we are, we're financial advisors. We want to act in the best interest of our clients. So what that means is we put our plan together, and then we go out into the marketplace and we find whatever products and or services are going to be the best suited products for our clients and their plan.
And something caught my eye there when you said fiduciary. Doesn't everybody act as a fiduciary?
Well, they're supposed to now. We always have, of course, because of the licenses that we have. You know, when you're an investment advisor and you have these certain licenses, you're acting in that capacity. But now they've kind of even the playing field with some of the regulation, and they're really requiring all financial advisors to act in that fiduciary capacity, which means that you're acting in the best interest of your clients. So now, and with this regulation, I mean, it's really, it's really kind of caused some a lot of adjustment, I should say, in the marketplace. And I think there's going to continue to be adjustment in the marketplace. And all this is, for the most part, this is all good for the consumer.
Yep.
It's good for the consumer because it gives the consumer, I think the consumers are going to have better choices. They're going to know that their advisors are working in their best interest. And I'm not always a big proponent of having more government regulation because that's not always a great thing. Yep. But the fact that we're giving the consumers what all consumers should always be getting, and that is working with a financial advisor that's giving them the proper advice.
Yep. And I know you talked a lot about planning, but if we take a step back to someone meets you for the first time, like what's the first meeting look like?
The first meeting is a get to know you meeting. Okay. That's what we're doing. We're getting to know our prospective client, and the prospective client is getting to know us, because there has to be a big trust factor built up before we can conduct any business. So we want to get to know what the client's goals and objectives are, why they came in to see me, what we can do to help them, what some of the parameters of the plan are, and then from their perspective, they want to know what we're all about, what kind of firm we are, how we handle our clients, how we conduct our meetings, how frequently we conduct our meetings. It's really, and that's really something that, the consumer should be doing. Buyer beware. You want to know who you're dealing with. You want to know what, and now we're in such the age of information. All this stuff's on the internet. I mean, you can go out on the internet and check our background and our licenses and all that stuff, which consumers should be doing. They should be checking that. So these meetings, this initial meeting is a good meeting to just to kind of get to know. We want to get to know one another. We want to get to know the prospective client. Prospective client wants to get to know us, ask whatever questions they want to ask to become comfortable with, eventually maybe conducting business together.
Okay. And I see we have some upcoming seminars.
Yes, we take our show on the road. In addition to doing our TV show right here in the wonderful studios here at PCTV, right here in Pottstown. And the reason we're doing the TV show is not only for our listeners here in Pottstown, or our viewers, I should say. I still say listeners because we used to do radio, but now we're doing TV, so it's viewers. So our viewers here in the Pottstown area, here on PCTV, get to watch us on the local cable. But we also stream our show on the PCTV network, which is thepctvnetwork.com. And we also stream it on our website, which is informedfamily.com. But in addition to that, we take our show on the road. So we've got a couple of events that are coming up. And if you want to come to see one of our events, and we talk about a lot of stuff that we talk about here on the show. We talk about, retirement planning, IRA planning, Social Security. There's a lot of different topics that we cover during those events. So if you're interested, give our office a call for tickets. You can come see us live. Maybe even we'll sign some autographs at the end. But email us, give us a call. You can email us at info@informedfamily.com or give us a call there at the number up on the screen. We'd love to hear you. We'd love to see you. So with that being said, we're going to put the wrap on another show. This is a good show this morning, or I should say today, talking about fixed income, talking about bonds, and how it really relates to an overall portfolio. So with that being said, until next time, this is Jeff Bush, and this is Financially Speaking with Jeff Bush.